Silver behaves differently from larger, more liquid markets, and this difference is not cosmetic. Its market structure is smaller, thinner, and more reactive, which magnifies every shift in sentiment. Compared to gold, fewer transactions are required to move prices, and fewer participants are needed to change direction. This structural reality means that silver absorbs stress less efficiently, especially when activity increases suddenly. Because of its limited depth, silver tends to move more aggressively than gold in both rising and falling conditions. During advances, this creates the impression of strength and acceleration. During declines, the same characteristic becomes a liability. Selling pressure encounters less resistance, allowing price to fall rapidly once momentum turns. What might be a controlled pullback in a deeper market becomes a sharp break in silver. Liquidity constraints amplify emotional responses. Rapid price changes force participants to react rather than evaluate. Decisions are made under pressure, often driven by risk limits rather than analysis. This dynamic reduces stability precisely when it is needed most. The market becomes more sensitive to flows than to fundamentals, and short-term behavior dominates outcomes. Understanding silver's structural sensitivity is essential because it explains why volatility is not an anomaly but a feature. The metal's smaller market size ensures that periods of heightened interest also bring heightened risk. Without acknowledging this structural reality, participants misinterpret both rallies and sell-offs, underestimating how quickly conditions can shift against them. As interest intensifies, silver enters a state where emotion begins to outweigh equilibrium. This environment is described as an emotional zone, defined by volatility that expands beyond normal bounds. Price movements grow larger and faster, and reactions become increasingly amplified. In this state, the market no longer processes information calmly. It responds reflexively with momentum and positioning, driving outcomes more than measured assessment. This emotional condition develops when expectations rise rapidly and become widely shared. As more participants align around the same outlook, the market's tolerance for disruption declines. Confidence becomes conditional on continued upward movement. Any interruption, even a modest one, introduces stress. Volatility does not simply increase, it becomes the organizing force of the market. Expanded volatility changes the risk profile fundamentally. Gains may appear swift, but losses materialize even faster. Sharp swings compress decision-making time, leaving little room for adjustment. Participants relying on stability find themselves exposed to movements that exceed their assumptions. The market begins to punish hesitation and reward only those positioned to endure instability. In this environment, long-term narratives lose their immediate influence. Structural forces take precedence, and discipline becomes more important than conviction. The emotional zone transforms silver from a directional trade into a stress test. Recognizing this shift is critical because ignoring it leads participants to underestimate how quickly conditions can deteriorate, even when the broader outlook remains unchanged. Leverage becomes most influential precisely when emotion is elevated. As bold price projections circulate and volatility expands, participation in futures markets increases in scale and intensity. Positions are established with the expectation that momentum will persist, but these positions depend on borrowed exposure rather than fully committed capital. This creates a market that appears confident on the surface while remaining structurally fragile beneath it. In a highly leveraged environment, price movements translate directly into financial pressure. Even relatively small declines can threaten margin thresholds, forcing participants to react immediately. These reactions are not discretionary. They're mandated by the mechanics of leverage. As positions are reduced or closed to meet requirements, selling pressure intensifies regardless of the broader outlook. The risk escalates when leverage is widely shared across the market. As prices fall, the liquidation of one position contributes to further declines, triggering additional margin stress elsewhere. This chain reaction accelerates rapidly. What begins as a correction evolves into a cascade, driven not by a shift in fundamentals, but by the need to resolve accumulated exposure. This dynamic explains why silver can experience abrupt collapses during periods of heightened interest. Strength in long-term demand does not interrupt the process. Leverage compresses time and forces outcomes before narratives can stabilize. Understanding this mechanism is essential because it reveals how structural fragility, rather than fundamental weakness, can dominate price behavior in critical moments. As leverage-driven activity expands, the separation between paper contracts and physical silver becomes more pronounced. These two layers of the market operate under different constraints. Paper exposure can be created and unwound rapidly, responding instantly to price movement and margin pressure. Physical metal, by contrast, is bound by availability, delivery, and logistical limits. When paper participation grows faster than access to physical supply, imbalance builds quietly. This divergence matters most during periods of stress. Under normal conditions, the difference between paper and physical remains largely invisible. Trading continues, contracts settle, and price appears orderly. But when volatility intensifies, the mismatch becomes active. Paper positions are reduced at speed, while physical demand cannot respond quickly enough to counteract the selling. Price begins to reflect financial pressure rather than material reality. In these moments, price declines do not signal a sudden absence of demand. They signal the urgency of unwinding exposure. The financial layer of the market moves first and fastest, dragging prices lower even as physical interest remains present. This disconnect creates confusion for participants who expect supply constraints to provide immediate support. The widening gap between paper and physical silver adds another layer of instability. It delays equilibrium and deepens swings. Until excess paper exposure is resolved, prices remain vulnerable to abrupt movement. Recognizing this separation is critical because it explains why silver can experience sharp declines without contradicting its longer-term supply dynamics. When the imbalance between leverage and liquidity reaches a critical point, forced liquidation takes control of price behavior. This process unfolds mechanically, not sentimentally. As prices move lower, margin requirements tighten, and positions that were sustainable only moments earlier become untenable. Participants are compelled to exit, regardless of conviction or outlook. The market shifts from choice to obligation. Forced selling accelerates rapidly because it feeds on itself. Each wave of liquidation pushes prices further down, activating additional margin pressure across the market. What begins as a manageable decline transforms into a cascading unwind. In this phase, price no longer communicates value or expectation. It reflects urgency, as positions are closed to meet financial constraints rather than strategic decisions. This dynamic explains how sharp collapses can occur even when underlying conditions have not deteriorated. Long-term demand remains present, but it operates on a slower timeline. It cannot intervene fast enough to halt a liquidation cycle driven by leverage. The market must first clear excess exposure before stability can return. The damage caused during these episodes is often misunderstood. Losses are attributed to incorrect forecasts rather than structural stress. In reality, the outcome is shaped by positioning and leverage interacting with volatility. Without recognizing this mechanism, participants misread forced liquidation as a failure of the broader thesis, when it is instead the consequence of an overloaded market correcting itself under pressure. Long-term supply and demand conditions continue to shape silver's broader trajectory, but they do not provide immediate protection during periods of structural stress. Industrial demand remains strong and consistently exceeds available supply, creating an underlying floor over time. This imbalance supports the argument for higher prices in the long run, but it does not prevent sharp declines when financial pressure dominates market behavior. Silver supply is constrained by the way it is produced. Much of it comes as a byproduct of mining other metals, which limits how quickly output can respond to rising prices or sudden increases in demand. These constraints contribute to long-term scarcity, yet they operate slowly. Financial markets, by contrast, adjust instantly. When leverage unwinds, price responds to liquidity conditions, not production realities. This mismatch in timing is where many investors miscalculate risk. Strong demand does not halt forced selling. It waits until leverage has been cleared and stability begins to reestablish itself. During liquidation phases, prices can fall even as physical demand remains intact, because the market is resolving excess exposure rather than evaluating scarcity. Understanding this distinction is essential. Supply and demand influence direction over extended periods, but they do not override short-term mechanics. Confusing long-term support with short-term safety leads to misplaced confidence. The market can remain fundamentally strong while still inflicting significant damage on those exposed at the wrong moment. Significant losses in silver most often occur when participants underestimate the discipline required to endure its volatility. Entering the market with a strong belief in future prices does not reduce exposure to sudden swings. Without preparation, investors are forced to react to movements that unfold faster than expected, making decisions under pressure rather than through strategy. Rapid declines provoke fear, while sharp rebounds restore confidence prematurely. This cycle destabilizes behavior. Positions are adjusted at unfavorable moments, not because conditions have been properly assessed, but because emotional stress overwhelms planning. Over time, this erosion of discipline becomes more damaging than any single price movement. The assumption that volatility is temporary leads to repeated misjudgment. In silver, volatility is structural. It magnifies both optimism and panic, testing tolerance continuously. Those who lack a framework for managing these swings find their capital gradually reduced, not by being wrong about direction, but by being exposed during instability. Survival in this market depends on respecting its mechanics. Timing, positioning, and risk tolerance matter as much as long-term outlook. Without that understanding, even accurate expectations about future prices fail to translate into positive outcomes. Silver does not reward conviction alone. It rewards those prepared to withstand its inherent turbulence. Periods of stress reveal more about silver than periods of enthusiasm. Declines expose whether selling pressure is voluntary or forced. When price falls, accelerate, and trading activity increases, it indicates that leverage is still being unwound. These moments suggest that the market has not yet reached equilibrium and that structural pressure remains unresolved beneath the surface. Recovery behavior is equally revealing. Uneven or hesitant rebounds signal that confidence has not fully returned and that positioning remains fragile. Stability is not measured by how high prices rise, but by how they respond after falling. Until selling pressure subsides and recoveries become consistent, volatility remains a dominant force rather than a temporary disruption. Gold provides context, but not insulation. While it reflects broader sentiment, silver frequently diverges during periods of stress. Fear is amplified rather than absorbed. Relying on gold's behavior to infer silver's stability leads to misinterpretation when volatility expands. Silver reacts faster, moves further, and exposes imbalance more aggressively. Observing these behaviors shifts focus away from predictions and toward mechanics. Price targets offer little insight during instability. Market behavior does. Understanding how silver responds under pressure allows participants to assess whether stress is intensifying or receding, replacing reaction with interpretation. Silver ultimately demands respect for its structure rather than confidence in its destination. Its long-term potential exists alongside persistent instability, and one does not negate the other. The path toward higher prices is shaped by volatility, leverage, and structural stress that operate independently of belief. Ignoring these forces turns optimism into vulnerability. This market does not punish conviction, but it does punish unpreparedness. Survival depends on recognizing that turbulence is not an exception, but a condition. Awareness, discipline, and restraint become prerequisites rather than preferences. Without them, even accurate long-term expectations fail to protect capital. The warning is not that silver cannot rise. It is that the journey is unforgiving. Those who focus only on outcomes overlook the mechanisms that determine who remains intact long enough to benefit. In silver, survival comes before reward. Only those who respect its mechanics can endure the volatility required to reach any destination at all.